74% of the world's central banks expect the US dollar's share of global reserves to fall over the next 5 years. So these aren't analysts. We're not talking about commentators. These are the reserve managers themselves in a survey published by the World Gold Council this month. You already know they've been buying gold, 1,000 tons a year for 4 years straight, double the previous decade. But here's what's new, and what most people have pretty much missed entirely. They are now physically moving it. They are relocating those sovereign gold reserves. They are changing who holds it and where. And the World Gold Council research this week has confirmed it. So why now? What do they know about the stability of the current system that is making custody, not just ownership, their new priority? And that is what this video is about. This week, the World Gold Council published a new survey, 76 central bank respondents, the most comprehensive read on official sector gold strategy available. Now, most of what you'll see covered is about focuses on the buying figures, 1,000 tons a year, record demand. We know. But there's a second set of data we really have to look at that came from the same survey. And it really changes about how you need to think about every other number in this report. Because in the past 12 months, the proportion of central banks actively moving their gold, physically relocating it, changing who holds it and under what jurisdiction, that has nearly doubled. And we are going to look at why the buying has happened, but also why the moving is far more important read here. If you are holding physical gold right now, the single most useful question isn't about what the price is doing. It's about whether or not the institutions with the most sophisticated risk frameworks in the world are still adding to their positions, and at what pace. Now, in 2022, central banks, they bought 1,082 tons of gold, and this was the highest figure since 1967. In 23, they bought 1,049 tons. In 24, 1,045 tons. So back-to-back years of 1,000 tons or more. So it wasn't a post-pandemic anomaly. It became a sustained, deliberate accumulation, which is at a pace that the gold market had not seen for over 50 years. Put that all in context, before 2010, central banks, they were net sellers of gold. They were offloading reserves that had accumulated during the Bretton Woods era. They were treating gold more as a legacy asset that paid no yield. They didn't see it as serving a modern monetary purpose. And that was a consensus that held for decades. But then it all reversed. And that pace, well, it surprised even the institutions themselves, and the World Gold Council asked them directly. And now 89% of respondents expect global central bank gold reserve to increase over the next 12 months. This is a record 45% expecting their own institutions' reserves to rise. 1%, expects a reduction. So that is not a market that is clearly divided on gold. It is a near unanimous conviction at the official sector level. And what is so unusual about that conviction? Well, it's that these institutions have been buying through all-time highs. They haven't seen price as a deterrent. And that needs to get you to, as an investor, stop asking, has the gold price gone too far, too fast? Well, central banks running reserve portfolios worth trillions of dollars, they weren't pausing at those record prices. They continue to accumulate. And why is that? Well, because you weren't managing a sovereign reserve portfolio. The relevant question you're asking isn't what is the gold price today, it's what does this asset do when everything else is breaking down? And gold's the answer to that question. It has been the consistent answer to that question for thousands of years. At 1,000 tons a year, it appears that reserve managers agree. But the scale alone here isn't explaining the urgency we're seeing. And for that, you have to look at specifically what has changed and how these institutions are thinking about risk and about the assets that they are used to trusting. Now, the scale tells you that they are committed, but committed institutions don't necessarily change behavior at this pace without a very specific trigger. And the World Gold Council asked them, well, why gold? Why now? Why at the all-time highs? And the answers were pretty consistent across them. But one of them was a pretty more pointed than it appeared. There were three answers that dominated: performance during times of crisis, long-term store of value, and no default risk. And that last one is the one that you really have to zone in on: no default risk. In a world where the primary alternative reserve asset, US Treasury bonds, carries the full faith and credit of a sovereign government with $28 trillion and climbing of outstanding debt, no default risk is a pointed statement. And these are diplomatic institutions. They're not going to send out some press releases saying, oh, we're worried about the creditworthiness of the US government. But in an anonymous survey, the signal there was pretty clear. It was pretty unambiguous. 74% of respondents expect the dollar's share of global reserves to fall within 5 years. So we're not talking about a fringe view. This is the majority position among institutions that collectively hold trillions in reserve assets. And critically, they were asked where they expect gold's share to go, and a record 45% believe it will increase. The dollar retreats, gold advances. That is the story that is running very clearly through this report. And of course, the survey found that geopolitical hedging is now a primary driver for gold accumulation, particularly among central banks in emerging markets and in economies that sit outside of the traditional dollar bloc. So this isn't anti-Western sentiment expressed as a financial strategy. It's just institutions doing what institutions are supposed to do, managing tail risk. Now, the scale here obviously tells you that they're buying. We know what the motivation is, but the custody data about where they're choosing to hold it and how that's changed just in the last 12 months, well, that is giving you a very clear insight, and it is so much more urgent. Central banks, they are not just accumulating gold, they are physically moving it. In the past 12 months, 9% of respondents increased their domestic gold storage, i.e. held within their own country's borders, and that is up from 5% the year before. Another 10% diversified their overseas vaulting locations. That was up from just 2% the previous year. So that is a significant operational commitment, time going into these sorts of considerations. And why does it all matter? Well, that's because storage decisions are never made lightly. To move sovereign gold between jurisdictions that involves diplomatic logistics, security infrastructure, and legal agreements. When an institution goes to that level of effort, it's because the question of physical control has become so strategically relevant in a way that it just wasn't before. For the private investor, the parallel is pretty clear. The question of where and how you hold your gold, under whose legal framework, that is not some kind of administrative small cap detail. It's the difference between an asset and a claim on an asset. Central banks managing sovereign reserves with access to the best legal and geopolitical analysis available have concluded that physical custody in a stable, accessible jurisdiction is worth the logistical cost. And that judgment, those sorts of decisions, they didn't come from nowhere. And of course, that all brings us very much to the question of what your portfolio actually needs the answer to. It's not should I own gold, but what kind of gold exposure are you actually holding, and what happens to it if the conditions that are driving this central bank behavior get worse, not better. The World Gold Council's 2026 survey that was released yesterday captures the system in a very particular moment of transition. The institutions that anchor the global monetary order are simultaneously the institutions most actively building exposure to the one asset that sits outside it. 1,000 tons a year. 89% expecting that to continue, 74% anticipating a declining dollar share, and a meaningful, accelerating shift in where that gold is physically held. None of that is a prediction about next week's price. It's a very clear description of a structural realignment that has been building for 4 years, and it shows no sign of slowing. To understand why that is happening, not just that it is happening, that is what separates a reactive position from a considered one. If you want to understand how Goldcore approaches physical gold storage, allocated, segregated storage across safe jurisdictions, and what the custody question specifically means for private investors, click on the link below and book a free strategy call today.